Welcome back, everyone. We're talking about inflation today, a subject that's on everyone's mind. With prices so high and living expenses rising, it could seem impossible to succeed. However, what if I told you that there are ways to benefit from periods of extreme inflation in addition to just surviving them? Imagine transforming a difficult financial circumstance into a chance for financial advancement. It sounds fascinating, doesn't it? In this video, we'll look at some wise decisions you can make to safeguard your wealth and even profit during periods of severe inflation. We'll go over everything from buying commodities and physical assets to investing in equities that are immune to inflation. We'll also go over how to stay ahead of the curve by using real estate and other tactics. Thus, stay put if you want to protect your money and take advantage of a challenging economic environment. Before we begin, remember to click the subscribe button to receive more advice on surviving and prospering in the current economic climate. Now let's get going. How is inflation measured? Inflation is defined as a change in the price of goods and services. It expresses the change in prices since the last measurement as a percentage rate. Although encouraging inflation may seem counterintuitive, a moderate amount of it benefits an economy because it encourages lending, borrowing, and expansion. The U.S. Federal Reserve views maintaining price stability and maximizing employment as being most compatible with its dual mandate, and it sets long-term goals for average inflation of 2%. In order to calculate the inflation rate, a number of organizations specifically select the costs of products, services, and other affecting variables. The Kellin Effect. The Kellin Effect is one of the most important concepts for understanding inflation. This phenomenon, which bears the name of 18th century economist Richard Kellin, is the result of freshly minted money moving through an economy in an uneven manner. The initial recipients of the newly created money stand to gain the most, while those who receive it later bear the brunt of growing costs. To benefit from the Kellin Effect, place yourself in a position closer to the source of fresh money generation. It may be necessary to invest in securities that directly benefit from money printing, such as stocks or real estate. The velocity of money explained. Money velocity measures the speed at which money moves within an economy. Money tends to move more quickly during periods of severe inflation as people race to spend their money before it becomes worthless. This extra spending may contribute to inflation. Investing in companies that profit from rising consumer spending is one way to take advantage of this dynamic. These businesses are likely to experience revenue growth, which could result in higher stock prices and possible capital gains. What massive money printing creates? While central banks' massive money printing leads to inflation, it also presents possibilities for investors. Asset prices typically increase when there is more money in circulation in the economy. Assets such as gold and real estate, perceived as safe havens or wealth stores, are particularly susceptible to this trend. When the value of these assets rises in response to inflation, investing in them can help safeguard your wealth and possibly yield benefits. Real versus nominal inflation. Knowing the distinction between nominal and real inflation is crucial. Real inflation refers to the increase in the cost of living after accounting for inflation, while nominal inflation refers to the rise in the overall price level. To benefit from inflation, concentrate on investments that provide returns higher than the real rate of inflation. By doing this, you may make sure that your wealth increases even when money's purchasing power decreases. Inflation transfers wealth to borrowers. Borrowers typically gain when there is inflation at the expense of lenders. This is because as time passes, the amount they owe declines in value, which lowers the cost of their debt when repaid in fresh, inflation-adjusted dollars. Consider taking out long-term, low-interest debt to invest in growing assets in order to profit from this wealth transfer. When the value of assets rises and the value of debt decreases, there should be a net gain. Inflation transfers wealth to homeowners. Because of the rising value of their properties, homeowners frequently profit from inflation. Because there is more demand for housing, living expenses and prices rise. As a result, homeowners may experience significant equity increases. To benefit from inflation, think about investing in real estate or purchasing a house. This can serve as a hedge against future capital gains and inflation. Inflation transfers wealth to asset owners. During periods of inflation, tangible asset values typically increase more quickly than the inflation rate. This implies that even if money's purchasing power declines, owners of assets like stocks, real estate, and commodities may perceive a gain in their wealth. Invest in a diverse portfolio of assets that are likely to increase in value during inflationary periods if you want to profit from this transfer of wealth. Good debt versus bad debt. Not every debt is paid equally. People use bad debt to purchase items that quickly lose value or don't generate income, while they use good debt to finance investments that do both. To buy assets that will appreciate in value during inflation, concentrate on quality debt. To accumulate wealth during inflation, use prudent debt to fund investments in properties such as real estate or companies that can provide both capital gains and cash flow. Leverage multiplies returns. Using borrowed funds to increase the possible return on investment is known as leverage. During inflationary periods, leverage can be powerful because it enables investors to purchase more assets that appreciate while using less of their resources. Take advantage of leverage by financing investments and assets projected to appreciate during inflationary periods through low-interest loans. This can accelerate money accumulation and increase returns. Using debt to create wealth. When used properly, debt may be a very effective instrument for generating wealth. Transferring wealth during periods of inflation may be beneficial if you invest in appreciating assets using low-interest, long-term financing. Buy assets that can appreciate in value and provide cash flow if you want to take advantage of inflation and leverage debt to build wealth. This can enable you to increase your wealth in spite of the falling value of money. I appreciate you looking. Remember to subscribe and like our YouTube channel.